Gold is entering a pivotal phase where macro forces, geopolitical tensions, structural capital shifts converge, creating a rare window for investors to reassess long-term value and strategic positioning. Gold remains one of the most strategically important assets in global financial markets, and its price structure over the past several years reflects a complex interaction of monetary, geopolitical, and structural factors rather than any single dominant driver. To assess gold accurately, analysts need to examine not only the cyclical environment shaped by interest rates and inflation, but also the deeper, long-term shifts in global capital flows, central bank intentions, energy transitions, and systemic financial vulnerabilities. The current cycle is not merely another episode of safe haven rotation. Instead, it represents a broad revaluation of the role of hard assets in a world where fiat liquidity, geopolitical equilibria, and long-term real yield trajectories are undergoing significant reconfiguration. The fundamental anchor of gold pricing continues to be real interest rates. Historically, gold has exhibited a strong inverse correlation with real yields because rising real yields increase the opportunity cost of holding a non-income generating asset. However, in this cycle, the relationship has decoupled. Real yields climbed sharply into positive territory while gold simultaneously forged new all-time highs. This structural divergence is meaningful. It indicates a shift in global portfolio preferences, in which gold is no longer viewed solely through the lens of opportunity cost, but increasingly as a strategic risk-offsetting asset. Investors and sovereign institutions are responding not only to inflation uncertainty, but also to concerns over debt sustainability, geopolitical fragmentation, and the long-term reliability of major reserve currencies. The most transformative change in the gold market is the massive wave of central bank buying. Since 2022, central banks have accumulated gold at the fastest pace in more than half a century. And this accumulation is not a cyclical reaction to short-term volatility. It is a deliberate structural realignment of reserve composition, centered around the desire to reduce dependence on the US dollar. This shift is especially pronounced in emerging market economies, where policymakers see gold as a stabilizing anchor that is immune to sanctions risk, dollar liquidity fluctuations, and political changes in the West. Central bank demand is inherently price insensitive. These institutions buy gold as a policy action, not a speculative one. As they continue removing supply from the open market, available float for private investors diminishes, creating a foundation that reduces downside volatility and lifts the long-term equilibrium price. In parallel, Asian physical markets have become increasingly dominant. China and India experienced substantial growth in both economic scale and household wealth over recent decades. Much of that incremental wealth channels naturally into gold. These markets respond strongly to currency weakness, equity, instability, or concerns about real estate values. China's slow recovery, high domestic savings rates, and concerns about yuan depreciation have all contributed to a surge in private gold buying. These flows operate independently of Western ETF positioning, which makes gold today far less vulnerable to ETF outflows than in previous decades. Monetary conditions add another layer to upward pressure on gold. Although inflation has moderated from its post-pandemic extremes, it remains stickier in the services sector, and long-term inflation expectations have drifted modestly upward. The Federal Reserve is expected to transition from an extended tightening phase to a gradual easing cycle. Although the exact timing remains data-dependent, what matters for gold is not the precision of the schedule, but the directional shift in real rate expectations. Once investors internalize the view that real rates have peaked or are structurally capped due to fiscal constraints, the attractiveness of long-duration bonds diminishes and alternative stores of value become more appealing. Historically, when the Fed shifts from tightening to easing, gold responds with disproportionately strong performance. Often entering multi-quarter uptrends, the US dollar's trajectory is equally important. Although the dollar has remained resilient due to interest rate differentials and global liquidity demand, a prolonged period of dollar strength typically gives way once policy normalization begins. Gold does not require a collapsing dollar to rally. It requires only the end of the strengthening phase. Once global markets believe the dollar has topped, capital flows often rotate toward diversification assets, with gold standing among the primary beneficiaries. Another factor reshaping gold. Dynamics is the state of global public finances. Government debt levels in major advanced economies are historically elevated. Fiscal consolidation remains politically difficult. As debt-to-GDP ratios rise, monetary authorities face stronger incentives to maintain inflation slightly above target to gradually erode real debt burdens. Even mild but persistent inflation effectively taxes bondholders, pushing investors to increase allocations to real assets. Gold, as a non-sovereign store of value, becomes more attractive under these conditions. This long-term fiscal-monetary interplay is a critical structural driver that supports gold's upward drift. Geopolitical risk persists as an unpredictable but powerful catalyst. With conflicts, trade rearrangements, and technological competition between major powers intensifying, gold serves as an essential hedge against systemic tail risks. Whenever geopolitical uncertainty escalates, whether through military incidents, sanctions, or disruptions in supply chains, safe haven flows reinforce upward pressure on gold. On the supply side, gold mining production is growing slowly, constrained by limited major discoveries, longer permitting processes, rising costs. In stricter regulatory environments, even if prices rise further, new supply takes years to materialize. This supply inertia, coupled with robust policy-linked demand, creates a structurally tightening environment that is supportive of long-term price appreciation. Technical market structure complements these fundamentals. Gold has been carving out steadily rising support levels, with each major correction stopping at higher floors. Market depth shows strong institutional bids during pullbacks, reflecting a conviction made possible by central bank demand and long-term macro trends. When momentum indicators align with macro catalysts, gold tends to break resistance zones decisively, creating multi-month price expansions. Given the interplay of these factors, gold is operating within a multi-layered support system. Central banks as structural buyers, Asia as a powerful physical demand engine, the Fed approaching a policy pivot, sticky inflation, elevated debt, and geopolitical volatility. This environment forms the analytical foundation for projecting the metal's medium-term trajectory. A comprehensive medium-term projection for gold requires integrating quantitative macro indicators, market sentiment measures, ETF behavior, central bank trends, and technical break zones. This part focuses on how these variables shape the expected path of gold prices over the next 12 to 18 months. The starting point is real interest rates. If real yields remain elevated, gold may temporarily consolidate or correct. However, real yields are unlikely to rise meaningfully for structural reasons. U.S. economic data shows moderating consumption growth, slowing labor market tightness, and cooling inflation momentum. These trends support the expectation of gradual policy easing. Historical regression models suggest that when real yields decline by 50 to 100 basis points over a year, gold tends to appreciate between 12 and 20%, even without major geopolitical shocks. Should the Federal Reserve initiate a sustained reduction in rates, this would lower the hurdle rate for holding gold and trigger renewed interest from long duration. Institutional portfolios. Central bank accumulation remains the most stable pillar of future demand. Forecast models based on reserve composition trends suggest emerging markets could continue adding 300 to 600 tons of gold annually, depending on exchange rate dynamics and geopolitical developments. Even if purchases moderate slightly, the net structural effect remains strongly supportive. Importantly, no major central bank is expected to reduce gold reserves meaningfully, which removes a historical risk factor. ETF behavior is likely to shift as well. Western investors were net sellers in previous quarters, but quantitative analysis shows that ETF flows typically lag monetary policy by 3 to 6 months. Once rate cuts begin, ETF inflows tend to reappear, creating a secondary demand wave layered on top of central bank accumulation. If ETF holdings return to their previous cyclical peaks, this alone could add over 300 tons of demand, annually a powerful accelerant to upward price pressure. Physical demand from Asia remains a wild card, but leans bullish. Chinese households continue diversifying into gold as a response to currency concerns and the weak property sector. India, with ongoing economic growth and rising disposable income, provides strong baseline demand. Seasonal buying patterns in Asia further reinforce price stability during times of global volatility. The macroeconomic backdrop supports this demand profile. Most major economies appear to be entering a slowflation environment, low growth, moderate inflation, and high fiscal deficits. This environment historically correlates positively with gold performance. Portfolio managers seek assets that preserve real value and reduce exposure to sovereign debt risk, making gold attractive in strategic asset allocation models. Moreover, gold's correlation with equities tends to become negative during risk-off episodes, increasing its utility as a portfolio hedge. Technical signals reinforce the bullish medium-term case. Gold has established multiple support zones that coincide with significant volume accumulation. The primary long-term support cluster rests near the lower end of recent consolidation ranges. Above current trading levels, the main resistance appears near previous cycle highs. A clean breakout often triggers systematic buying from momentum funds and quantitative trend followers. Given gold's reduced sensitivity to ETF outflows and heavy sovereign demand underneath the market, upward breakouts can be sustained more easily than in past decades. With all variables considered, a medium-term forecast can be constructed through a scenario framework. The baseline scenario reflects moderate easing by the Federal Reserve, stable central bank demand, and relatively calm but unresolved geopolitical conditions. In this case, gold is likely to fluctuate in the 2,400 to 2,650 USD per ounce range, with intermittent corrections, but a general upward drift. The baseline outlook also assumes steady Asian demand and a gradual return of ETF inflows. Creating layered support zones, the bullish scenario incorporates synchronized global rate cuts, a softer US dollar, elevation in geopolitical tensions, and a swift return of institutional investor interest. Under these conditions, gold could rally into the 2,700 to 2,900 USD range. Strong ETF inflows combined with continued central bank purchases create the conditions for a sustained breakout. Given the structural changes in global liquidity preferences, such a scenario is not only plausible, but increasingly probable if global economic softness persists. The bearish scenario requires a significant shift in macro conditions, an unexpectedly hawkish Federal Reserve, a sharp rise in real yields, or a strong and sustained dollar rally. In such a case, gold could correct to the 2,150 to 2,250 range. However, sustained moves below that level appear unlikely given the scale of structural demand from central banks in Asia. Unlike previous decades, gold now has a built-in demand buffer that limits deep downside volatility, taking all analytical dimensions into account. The medium-term outlook for gold remains strategically bullish. The combination of policy shifts, geopolitical uncertainty, structural demand, slow supply growth, and evolving portfolio practices continues to elevate gold's importance in global markets. Over the next 12 to 18 months, most probable outcome is a continued uptrend supported by both cyclical catalysts and long-term structural realignment.